Welcome to the first quarterly market update for IMFG. My name is Scott Douglas. I'm here with Dr. Steve Garth, who's on our investment committee. And Steve, I'd like to ask you, how has it been over the last quarter and what's been going on? What are some of the themes that we've been seeing?
Yeah, sure, Scott. Well, I don't think this will be a surprise to anyone, but it's been a very volatile year last year in markets. And that really was so true in the last quarter. This might surprise people, but markets around the world were up. There was quite a rally last year. It all ended close to the end of the year when, once again, the Federal Reserve in the US came out and said, look, there are more rate rises to come, and that the terminal rate is probably higher than where the market is thinking it is. Scott, let's start by having a look at what Australia and the US have done over the year. And you can see in this chart here, again, the volatility. But Australia up by, 9.4% in the quarter, phenomenal. And that was nearly enough to make it at least an even year, which under the circumstances would have been fantastic. In the end, Australia down by minus 1.1%. But if you look at the US, also had that positive quarter, but for the year, they're down by 18%. That's a big difference.
Yeah, right. So within let's talk about the global part. What are the areas that have sort of been impacted the most or had the most influence on that negative 18%?
Yeah, so let's have a look at this chart. It's sort of major indices. We just talked about the S&P 500. That's the big US index, down by 18%. But Scott, about 40% of the US market is in the high-tech stocks, what they call the NASDAQ.
Yeah.
And when you look at the NASDAQ, you look at that index, that's down by over 32%. Right. Okay. So that is firmly what they call a bear market. Yeah. Now, other markets in Europe, that's down by about 10% for the year. Over in China, that's down by 20% for the year. So you can see that overall Australia's done pretty well over the year relative to other markets.
Right, because we don't have those stocks in our portfolio, those types of stocks.
I think that's absolutely right. The IT sector in Australia, which is, by the way, the most negative sector in the ASX, but it only makes up about 3% of the overall market, so it's not enough to tilt the needle. What's given Australia that minus 1.1% as opposed to minus 10 or 20% is the resource sector. Once again, resources have come to the aid of the Australian market, and high commodity prices have boosted up resources, and that's a major part of our index. It's about 25% of our market.
Right, okay. So moving away from equities, the bond part of people's portfolios, which has been a big theme this last 12 months. How has that sort of wrapped up and where have we ended there?
Yeah, so it's definitely been a painful 12 months for people in bonds, and of course typically the more defensive people have more bonds, so it's been even more painful. But if you want to look at a glimmer of hope, in fact in the last quarter, once again, bond returns have finally turned positive. Now, not by very much, so overall Australian bonds, global bonds down by 10, 12% respectively, but in the last quarter there's a positive return there for bonds. And because we are reaching the end of this interest rate cycle, Scott, we're not exactly sure where it's going to end, but we don't think there's much more room left for bond yields to go up. Okay. So in fact, while it's been very painful for investors in bonds, there is actually that ray of light that they're now earning a much higher income than they were.
So for 2023, have you got any insights into what to...
Look, I'm not much good at forecasting, Scott. Yeah. It's widely believed that the US will go into recession in 2023. Australia, much less likely to do that. Either way, we do expect global economies to slow down. That sounds bad, but in fact, the market is well aware of this and may have already priced that in. Scott, we expect to see some volatility in the early part of 2023 as central banks continue to raise rates a little bit higher. But we do expect then that while the economy might slow, the market has priced that in, and not expecting the same sort of volatility this year that we had last year.
Right, okay. Well, that's great. Thanks very much, Steve. Really appreciate it. And look forward to working with you as clients in the 2023 year and sticking to your plan, and thank you very much.
Thanks.